to the Business Intercept. I am Kiara Ashanti, and tonight this episode is really going to be focused. This is part two on discussing what Joe Biden's economic plan is for the country as we move into the DNC convention this week. When he accepts the nomination formally for the Democrat, the nomination for the presidency. Yesterday or a couple of days ago, I released part one of this series in which I went over his plans for healthcare. I will link that video down below in the comment section. As I mentioned in that video, I'm pulling this information from Biden's own website, as well as some information from NPR, which did a story on what his general plans in different areas are. It's a big plan, a lot of moving parts, so we're going through this one subject at a time. And again, we went over healthcare in the first part. Today, we're going to talk about the biggie, taxes. So, what is Joe Biden's plan, economically speaking, when it comes to taxes? Now, if you happen to be an observer of politics, even casually, you already know kind of the deal with this. Democrats want to raise taxes, Republicans want to lower taxes. Really, what else is there to talk about? Well, in actuality, quite a lot, because it's not just a matter of raising or lowering the taxes, it's in what manner, on whom, and in what areas. And then also, one thing that we're going to have to touch on is COVID has thrown a bit of a curveball into the whole tax discussion this time around. And so we're going to talk about that as well. Now, listen, the Business Intercept, and I mention this in every single video because I think it's important. The purpose of this channel is to talk about business news, business events, the economy, Main Street economy, and different types of things that are going on in the country that can affect those. Normally, politics is really not what we get into. That's not really what I wanted this channel to be the focus of. Unfortunately, though, or fortunately, depending on how you want to view it, anything either president does have an effect on the economy, does have an effect on both big and small business, and therefore there are going to be stories surrounding the politics world that I think is we do need to go ahead and talk about. When we get to the Republicans next week, hey, I'll throw in a couple things about what Trump wants to do in his second term. He hasn't really said much about that, to be quite honest with you, but that's a discussion for another day. Let's talk about Joe Biden and taxes. Is he really his own man? Is he really been co-opted by Bernie? What's the good, the bad, and the ugly? I've written down some notes here, so what I'm going to do is be referring to them, because the last thing I want to do by anybody who finds this channel is to be accused of not being fair to Mr. Biden in terms of what his plans actually are. So let's start with basically the general premise. Joe Biden wants to raise taxes. He's a Democrat. They always believe in raising taxes, so we kind of start off from that baseline. But in what manner? Okay? It's funny because we go around and round in the country about this subject, lower, higher, and we always have this same conversation, not just because both parties are on opposite ends, but because when the Republicans are in office and manage to get a tax cut through, they never make it permanent. So we end up having this conversation yet again 4 years later, and it kind of goes round and round like a hamster in a wheel. Okay? Now, basically, this is where Joe Biden is kind of coming out on this. Right now, the highest income, about 20% of the households, people who make $170,000 or more, would bear nearly 93% of the burden of the taxes that Joe Biden is proposing that we're going to go through here. Okay. And then, of course, the top 1%, the Jeff Bezos of the world, the Mark Cubans, all of the billionaires, they are going to ostensibly get hit even harder because, of course, they're always the target. Okay. So let's kind of talk brass tacks in specifics. Okay. The first thing we want to talk about is, of course, that Biden wants to raise the top tax rate back to 39.6% from 37%, which is what Donald Trump lowered it to. And if you've been watching YouTube or seen the news, you've likely seen a video commercial that Trump has been putting out about Joe Biden and taxes. I'm going to play that for you right now. It's only about 15 or 20 seconds or so, but it illustrates two things. One we're going to talk about right now. In fact, we'll talk about both things right now because it's kind of important context for this whole discussion about what Biden wants to do, and then later on kind of what Trump is saying he wants to do. So here's the video.
Your taxes are going to be raised, not cut.
That means middle-class families, small businesses, and seniors pay higher taxes. It's the biggest tax increase in history.
All right, so according to the Trump campaign, what Biden wants to do, particularly with raising it back up to 39.6%, will be the largest tax increase in the history of the country. This is one of those situations, honestly, where it's like the difference between making a valid statement versus making a sound statement. Valid is a statement or a conclusion that follows logically based on the information presented to you. The soundness of a statement or an argument is how true it happens to be. This statement by Trump is valid, but not really sound. And I say that for this reason. Trump lowered taxes the most in the history of the country. So raising them back up to where he cut them technically is the highest tax rate in the history of the country, but it's not as if you're raising them past where they were. You're just resetting them to where they were before. So that adds a little bit deceptive if you're just being honest about it. Now, having said that, it's true that Democrats wanted to have a higher tax rate than it was before Donald Trump came into office. President Obama raised taxes, and Democrats, particularly those on the Bernie wing, didn't think that was enough as it is. Bernie would much rather see a situation where people, particularly in that top 1%, are paying anywhere from 50 or 60% of their income, and even wants to add on taxes on assets and not just income. But that's a discussion for another day because Bernie Sanders is not going to be president. Okay, so moving away from the top income tax bracket, what Joe wants to do is take capital gains and dividends and tax them at ordinary rates for those with annual incomes over $1 million. Now, this is why they want to do this. They consider people who make more than $1 million, regardless of what their expenses might be, they consider that the investment class. People who have, an excess amount of money, and therefore they're able to invest in real estate, stocks, other investments, get dividends, get capital gains from the sale of real estate or stocks, and of course that's additional income. Right now, of course, if you make capital gains from such transactions, the amount of taxes you pay on that is lower. I believe it's 15% right now is what it was lowered down to. They don't like that. What he wants to do is raise that up to ordinary income levels. So basically, if you are in the 39.6% tax bracket, which is where you would be if you're making over $1 million a year, they want to charge that same amount of rate of taxes on your capital gains. So if you make $100,000 and profits from the sale of a stock, rather than paying $15,000 in taxes right now, they want you to pay $39,600. That's what the plan is. Now, technically, that is double taxation, because essentially you've made $1 million and you pay income taxes on that, and then the money that you've made from that, you go and invest, and then they're taxing on that again. So capital gains taxes have always been a form of double taxation. Whether that's good or bad, I don't believe it's particularly good, and there are a lot of reasons for that, but we're not going to get into the pluses or minuses of that just yet. We might talk about that in a few minutes here. Okay. Then the other thing, of course, is he wants to tax unrealized capital gains at death. This is where you get into kind of triple taxation. So if you're not familiar, there's something called the estate tax. Okay. And Republicans call it the death tax. And the way it works is when you die, the government tallies up what your net worth is of all your assets that you had from when you from before when you passed, and that is over a certain amount of money, they tax all those assets. Okay, so there are certain exemptions, like each spouse, male or the wife, gets a certain amount of exemption on that, but once you're above that exemption, it falls into it. So let's say you have an estate of $10 million. Okay. And we're going to, just for simplicity's sakes, just take away worrying about what the actual amount that is exempt from that, because I want to make it easy numbers. What they would want to do is the estate tax right now is typically 50%. So you would pay, or rather your heirs would pay, $5 million of your $10 million estate to the government in estate taxes. Now, there are a few problems with that, and this is usually a problem that falls on the back heavily of farmers and ranchers, because a lot of times farmers and ranchers are rich in terms of land value, but they're not making a large income. And so what ends up happening a lot of time is that family members of someone who, whose mother or father just passed, and now they've got to worry about these estate taxes, they end up having to sell off portions of the land in order to pay the taxes. So here's the scenario. You make $1 million over the course of 25 years each year, and you're paying 39% on that. Then any investments that you make, they want you to pay 39% on that as well. So let's say you do some land improvements, put in some condos on your land, do a few other things that actually increase the value of the land, but you never sell it. Then when you die, you have to pay a further tax on those assets. Land, improvements, stocks, bonds, everything. So it's a triple taxation. Again, this is really hurtful to people who have assets but not a lot of cash flow. And literally within the insurance industry, there's a whole niche market, if you will, of insurance agents that don't do anything but sell insurance and annuities for dealing with estate taxes. Okay. Then what he wants to do is apply a Social Security to payroll tax for those earning over $400,000 a year. So if you look at your paycheck each week or every 2 weeks, you see your FICA and you see your Medicare. FICA is the portion that goes to Social Security. That amount that's taken out of your paycheck is taken out up until you make $400,000 currently. Anything above $400,000, you don't pay that tax anymore. You get to keep it. He wants to do away with that cap and let that continue on for however much you make. That's something that Democrats have been wanting to do for a while. That's on the table for what he wants to do. Then he wants to close what's called the stepped up basis loophole. Okay. Now, the stepped up basis loophole is one of those. I'm going to actually go to the site here that explains that, because it's something that most people don't really have to deal with, or because you really start dealing with hedge funds when you start looking at those types of things. So stepped up basis loophole. Okay. It's a tax law that applies to estate transfers. The heir pays capital gains on that basis. The result is a loophole in a tax that reduces or eliminates capital gains on the sale of those inherited goods. So basically, let's kind of go through a couple of examples of how this works. Okay, and I'm taking this from a website called thebalance.com. Google it if you want to go. I'll go ahead and put rather a link to this article in the description. So imagine that 1 out of 5 families in the United States, you earn a minimum of $8,333 per month. You live below your means, meaning you live way below how much you actually make each month, and you don't have any debt. Now, let's assume you finance the purchase of your home, but your mortgage payments are modest because, you're conservative with your money. And you plan on paying your mortgage off after you retire. You decide you're going to save 10% starting of your pre-tax income in a regular brokerage account or even through direct stock purchases. This is something a lot of people used to do with DRIPs. They're not as popular as they used to be in the 70s and 80s, but they're still around. Now, that 10%, you invest in a basket of stocks that compounds at a ravage rate of interest. Okay? And you keep this up for 35 years or so. You never increase your annual servings by the rate of inflation. So again, that eats into how much is actually going into the investment on a year-to-year basis. However, over the course of the years, you put aside $350,000 out of your own pocket. You end up with $2,710,000 sitting in your brokerage accounts, an unrealized gain of $2.3 million. Now, if you have to pay that stock, if you sell the stock rather, you have to pay capital gains. Then under Joe Biden's plan, that capital gains tax would be at 39% currently, okay? As well as any state or local taxes, which depends on what state you're in. If you're living in New York or LA, you're going to get hit with a nice extra bill. If you're living in Texas or California, you don't have to really worry about it. Okay? Now, you could gift that money to your heirs in a will or through a trust. And if your heirs turn around and invest that money in assets that earn them 10% rate of return, they might enjoy nearly $200,000 in personal net worth. Now, all you have to do is leave the appreciated shares, real estate, or other assets to your heirs when you die. The fair market value will be appraised, okay, and the heirs get to act if that price, the inherit price, is their cost basis. The stepped up cost basis loophole gives heirs 2 alternatives when it comes to taxes. First, if they hold on to the stock or real estate and it continues to produce average rate of return, they're earning it on a higher asset level of $2.7 million, not the lower 1.8 after taxes and all that. This means they enjoy an increase in wealth of around $271,000, not $189,000. That's an extra $81,000 or 42% per year. Okay. Meanwhile, the $813,000 in additional equity is sitting in their balance sheet and can lower their cost of borrowing elsewhere and serve as collateral. If they sell the stock, however, real estate or, again, whatever the asset happens to do, they can pocket the entire 2.7, and that's an extra $800,000 in real liquid cash. Okay, so by getting rid of the stepped up basis loophole, what they're essentially trying to do is make sure that you pay taxes on that higher amount, 2.7 million, and not the lower 2.3. See, because you didn't have to invest that $300,000. Your mother or father did. So of course, see, if they sell it, they get to deduct that $310 because that's their money. That $310,000 of their initial investment is coming back to them. But if they leave it to you, you never had to, put that money in. They want you to be able to be taxed at that higher level. Okay. So again, what the purpose behind all of these types of plans, whether it's the stepped up basis loophole, whether it's the death taxes, what they're trying to do ostensibly is keep wealth from accumulating in just a particular family. It's that old adage where they say the rich keeps getting richer. Well, that used to be the case 20s, 30s, 40s, because families would just leave their assets to their sons, daughters, grandkids, on, and that money would just keep on growing. Now, in actuality, that doesn't usually end up being the case for a myriad of different reasons, but that's on the surface, that's what they're worried about. And this is the government's way, from a democratic point of view, of trying to keep that from happening. Okay. So that's, what they want to do as far as personal income and personal assets. That's on the personal side. Then there's, of course, taxes on the business side of things. And the next thing in Joe Biden's plan with regard to taxes is to raise the top corporate income tax rate to 28% from 21. So Trump lowered it to 21. They want to raise it back up to 28. Now, 28 is actually better than where it used to be, which was at essentially 35% and was the highest tax rate in the world. This is why a lot of companies, both in the U.S. and a lot of foreign companies, wouldn't domicile their companies here. They would do it in other countries because they could go to Ireland, for instance, and get it for 15%, or they could go to the Cayman Islands or other tax havens and get no corporate income taxes and just pay fees in other ways. Okay, so they want to raise that back up. Then what they want to do is impose a 15% minimum tax on book income of large companies. And these would be companies that are at least of 100 million in annual net sales. So what do they mean by book income? Well, you use an analogy. Think about your personal taxes. You make $100,000 in 2020. But that's before you sit down on TurboTax or go to your your tax guy or gal and start doing your deductions. And let's say you're a business. So your business as a sole proprietor, let's say you cut lawns, all right? And you've got a decent business cutting lawns. You made $100,000, but you got all of these extra expenses, a few workers, well, not a few, the workers would be separate, gas, equipment, insurance, whatever the case may be. And after you take all your deductions, you send in on your income tax return, you made $50,000 a year, not the 100. That's similar to what large companies do. There's their book income, what their spreadsheets are showing their annual income was as a company before they do all of their tax write-offs, before they add any tax credits that they may have gotten, before they do any sort of equipment. Very often you can, when you buy large pieces of equipment, you can write off certain amounts of that cost every year. Or you can try to do it all at once, or you can decide to take a depreciation a little bit every year. Okay, just depends on what the company's trying to do for that particular year and what their books look like. What they want to do is essentially charge 15% based on what your actual book income is. And the reason I want to do that is because when you hear these stories about GE or Facebook or Amazon not paying any taxes for the year, it's because through a combination of tax credits, tax write-offs, and expenses that they can put against their book income, they can make it seem like they lost money for that year. So what they want to do with this plan is essentially say, regardless of what your income taxes might be for the corporation, you're going to spend at least 15% on your book income. Now, it's important to understand this is in addition to the corporate tax rate. This is not a substitute for it. So essentially, let's use Amazon. They make $2 billion in 2020. All right. They would want them to pay 28% in corporate income taxes on that $2 billion. And well, let me restate that. If they make $2 billion this year and they write it down to $1 billion, they would have to pay 28% on that $1 billion. And they want to charge 15% on the total book income, which would be 15% on $2 billion. So again, it's in addition to, it's another double tax. But that's their way ostensibly of combating the tax code that they agreed to. Okay. And then lastly, they want to tax profits earned from foreign subsidiaries of U.S. firms at 21%. And if you probably heard about this before, tax havens. There's always talk about tax havens for billionaires, as Bernie Sanders talks about. And this is the way this works in detail. Amazon decides that they want to distribute certain things in Asia. Okay. Rather than having Amazon USA do that, they open up a foreign subsidiary in, say, Ireland, where the corporate tax rate is much lower than here. And that subsidiary distributes whatever they're selling to Asia and Europe and that whole side of the world. Because it's a separate company, their profits and losses, whatever they happen to be, are under that subsidiary company, not Amazon USA. So if their foreign subsidiary made, $1 billion, that $1 billion really doesn't show up under Amazon USA. It shows up under Amazon Europe. Well, what they want to do is say, no, we're going to charge you 21% on that, even though it's not a company in the USA. So what ended up happening is Amazon would pay Ireland their 15% of corporate income taxes, and they would have to pay the 21% here in the US. So again, another form of double taxation. Now, what's the purpose of that? Well, the purpose is twofold. Let me back up. The purpose can be twofold depending on how you decide to look at things. If you're trying to be, quote, fair, you can say, well, they're getting out of paying income taxes here in the U.S. by opening up a foreign subsidiary, which in fact is true because that's why they're doing it. They don't want to pay the higher tax here. And of course, there are other reasons to have a foreign subsidiary too, particularly if you're distributing products. It's a lot less expensive to distribute on that side of the world when your products are on that side of the world versus shipping them from here over there. Okay, that's one of the reasons why a lot of companies have offices and companies in areas of Asia. The more cynical point of view on this is the Democratic way of essentially stealing money from the rich to give to the poor. Because at the end of the day, one of the things that's certainly a tenet of the Democratic Party this year, as a result of Bernie Sanders, mostly, but also a little bit AOC and the squad, is this idea of income equality. And what they want to do is make these companies and these rich people pay their fair share so that they can take that money and put it into universal health care, universal pre-K, into, take your socialist program of choice. That's where they want to get that money. So that's basically the plans. Okay. Who are the winners and losers under such a system? Well, the biggest winners actually will continue to be tax lawyers, CPAs, and accountants, because the tax code is complicated as hell already. Literally, there's continuing education every year and every couple years as new laws and procedures and things come into place. And of course, whenever the White House changes hands, you have to redo everything because inevitably the Democrats are able to get something they want through. They get kicked out the White House. The Republicans put something they want in, and it changes everything. So the complexity of the tax code is more convoluted than the veins in your body. Unless you plan to be a brainiac and try to figure it out on your own, don't try to do that. Trust me, don't. You need a tax lawyer, you need a CPA, you need accountants to do this for you so they will continue to be in good business, versus if we ever went into something where we had a like a single tax, a flat tax, or if we ever went to a tax that was more of a more consumption-based tax, really you wouldn't need lawyers and CPAs and tax accountants any longer. Okay. Foreign countries will also continue to gain. Look, when you are in big business, when you are in business where it is necessary for you to do, you're multinational. You're selling in the US, you're selling in Europe, you're selling in Australia, whatever the case may be. All right. It makes sense for you to find the best corporate tax rate that you can. All right. So if we raise it up to 28 and Ireland's at 15, the island of Man is at 5, the Cayman Islands are still at 0, companies are going to go to that. They're going to move their assets to that area. And even though they're saying ostensibly that they want to try to keep that from happening by charging U.S. firms 21%, that portion of it is probably ultimately not going to do it, because a lot of the companies that would hit are companies that contribute to the Democrat Party. All right, but once again, companies are just going to move offshore and open up foreign companies, and they won't be attached to them as subsidiaries. Jeff Bezos won't open Amazon Europe. He'll open up, something else, and it won't be a subsidiary of Amazon. So if it's not a subsidiary, they can't charge that 21%. And so we're going to talk about this in a second, but remember this particular point here, because this is where Democrats, whether you agree with raising tax rates or not, this is where they sort of make their mistake when it comes to tax policy, okay? People aren't just going to take it. And so I'm going to explain in a few minutes here exactly how that works. But let's continue to go through, some of the winners. And pretty much that will be it. Those will be the only winners. Losers. Well, it's going to be a slowdown in the economy. This is a natural result of this. Listen, the taxes are always a function of either the growth of the economy or people's income. If I go from $50,000 a year in income to $100,000 in income, that's better for the government ostensibly, because since I have a higher income, I'm paying more in taxes. Okay. But in order for that to happen, the economy has to grow. Salaries overall typically don't rise when the economy is contracting. The economy generally contracts when we have higher taxes, because not only do you have to have more money going to the government in the form of taxes, but people want to avoid that, and they avoid the higher tax in a few different ways. The most obvious way is they don't expand their business. A restaurateur doesn't open up an extra restaurant location. He just keeps his 3. He doesn't move from 3 to 6, because he looks at the tax code and with his tax accountant, and they determine mathematically that the extra profit that they're likely to gain from opening up those extra 3 locations are completely erased by the additional taxes that they would end up incurring as a result of having a higher income. So they look at the added costs of the restaurants, the added employment, in terms of wages. They look at the added taxes themselves, and they say, does this make sense from a return on investment idea? And they say no, so they don't do it. This happens to individuals as well. I was in the financial field for a very long time. I worked for Charles Schwab. I worked for Merrill Lynch. I worked for a number of different insurance companies. And in my positions, very often, there was a bonus attached to your production. And the more you produce, the more assets that you had under management, for instance, as a financial advisor, the higher your income. Well, I would know reps that would stop in, September or October, their production, because they knew if they made an extra $25,000, it would cost them and their family a whole lot more money in taxes. So they would just chill. They would just relax. They wouldn't sell as much. They wouldn't go out and market as much. And so, of course, that would hurt the company they're working for, because those are extra sales that they are potentially not getting. Those are extra assets that the company's not putting under management. But it is what it is. They're looking at their situation with their spouse and saying, if I make an extra $50,000, it's going to cost us an extra $40,000 in taxes. So they just don't do it. All right. So because of that, it drags down the economy even more. Okay. Other losers of this would actually be, I'm beginning to move into student loans, which is a subject for another day. That will be in part 3 of parts 3 and 4 are 2 small things that we're going to talk about, student loans. And so I started reading my notes from that. Okay. So let's talk about the extra curveball that we have going right now because of COVID. So we go back to the beginning premise. Democrats want to raise taxes. Republicans want to keep taxes low. Typically, Republicans want to keep taxes low, not only because they philosophically believe you should be able to keep more of the money that you earned, but they know as a practical level, the economy always grows when you have lower tax rates. We've seen this when Kennedy was president and he lowered taxes. We've seen this when Reagan was president and he lowered taxes. We even see this with Bill Clinton, who his first 2 years as president, taxes went up, went into a recession. He said enough of that. He filed, the Contract for America, lowered taxes, decided not to tax the internet, and boom, he ended up having a very successful economy and a very successful presidency as a result. Okay. Again, Bush came in, lowered taxes, the economy grew. Obama came in, raised taxes, the economy didn't really grow. This is just a cycle that goes on and on. It's pretty simple. When people have more of their own money in their pocket, they invest it or they spend it. And that helps the economy grow. So, what you've always got to keep in mind is there's a difference between raising tax rates and raising tax revenue. Democrats always want more revenue in order to pay for their social programs. Whether you agree or not agree with those programs is really not the issue. If you want to spend money on Medicare for all, on universal health care, then you have to get more tax revenue in the door. And their answer to this is always, we're going to raise tax rates. Well, what your rate isn't always what revenue you get. Because if I go from making $100,000 to making $65,000 because the economy has contracted as a result of this, then the government ends up with less money. And that's always what happens. That's why when we have higher tax rates, the amount of revenue we actually get into the government is always lower than the revenue we were getting when we had lower tax rates. Okay, because again, if I'm making 65 and then under a lower tax environment, the economy grows and I make $125,000, well, now you're getting income based on $125,000, not 65. That's generally what happens. And so with Trump lowering the taxes in the way that he did with his tax cut plan, we were going to see more tax revenue. And then COVID hit. And two things happened as a result of COVID. Not only does the economy contract because we essentially shut down the entire economy and people got fired because, of course, you've got businesses that, a restaurant can't stay open and keep paying their employees if they're not open, generating income. A sales organization, for instance, that sells office supplies can't keep all of their employees employed because there are no businesses buying office supplies. Why would they be buying office supplies? They're closed. But to combat this, Republicans decided that rather than government being the position of last resort, it was going to be the first choice for dealing with this. And they've spent $4 trillion so far in dealing with COVID. That's a lot of money. And that money, that amount of spending, essentially has rendered null any of the growth that we were going to get from a lower tax rate. So, to simplify this, whatever growth we were going to have as a result of the lower tax rate once the economy is back 100% running, essentially is going to have gotten eaten up by the $3 to $4 trillion that Republicans decided to spend in dealing with COVID. So I bring that up for two particular reasons. For the things that that Biden wants to do, not only in terms of health care that we talked about in the part one, but also in terms of student debt, that we're going to talk about in part 3, and dealing with climate, what we're going to talk about in part 4, all those things cost money. All right. And so they're going to say, we can't have these lower tax rates. We need the higher revenue because of the plans we want to do and because of the amount of spending that was done for COVID. Republicans don't have an answer for that question. I mean, literally, they can't really make an argument against socialism this time around, even though they're going to try, but they can't do it credibly because they use socialist tactics in order to deal with COVID. And as a practical matter, we're going to have to do something with the $3 to $4 trillion that we're now spending to deal with this. So the country is in a pickle because on one hand, you can't say we're going to keep tax rates low, right, when we just spent all this money. But on the other hand, you can't say we're going to keep the rates low in order to generate more revenue, because whatever extra revenue you're going to have created from the economy going back to a growth phase is essentially already eaten up by the money that you just decided to spend. So at best, the only way we could kind of get back to where we were going in terms of growth is if we ended up growing at like a 6 or 7% rate. And that's not going to happen. But that's literally not going to happen. We get back to normal and grow. Let's say Donald Trump gets reelected, and so the tax rate doesn't change, and we have growth of 2.5%, 3%, maybe 3.5% because of a rebound. Well, that's nice, but all that growth goes to all the money you spent for COVID, which means your net growth for the economy is essentially neutral. So the country and Republicans, to be quite honest with you, are in a pickle, and a huge pickle of their own doing. Now, if Biden wins and he's able to not only win the presidency, but the Democrats are able to take the Senate as well, if they hold all three chambers, White House, Senate, and House, then that first 2 years, he's got the ability to put all of these tax rates in place. Unfortunately, all of this is not going to help the economy, so we're going to end up being even further behind as a result of not only the spending that they want to do in their programs, but also, again, the spending that we're doing right now as it pertains to COVID relief. And that is essentially his tax plan. Now, there's one other aspect that we're going to end on that you have to think about. And that is the whole low income, middle income divide versus high income millionaire, billionaire divide. And by that I mean there's a certain percentage of the country, and they're not all Democrats either, that basically say, so what? This is all targeted toward people who have high incomes and therefore can pay this anyway. Now, putting aside the moral question of that point of view, that's not exactly correct, because a lot of the details of what they'll do in this plan will be eliminating certain tax breaks and bringing back certain fees, and those things all hit the middle class anyway. Medicare for all, if again, Joe Biden, based on his plan right now, is not going to go for Medicare for all, at least while he's campaigning. If he's to get in office, we'll see what happens then. But if they were able to put something like that in place, the amount of money that will be necessary in order to run it, you don't have enough rich people to pay for it. If you were to literally confiscate 100% of all the richest 100% of this country, you would still have a deficit in terms of the spending that you need in order to make Medicare for all even hope to work, which means the middle class and the working class are going to have to pick up the slack in some form or fashion. And how they hide that will really be more of a discussion about what's in the details of whatever tax bill he's able to put forth. Remember, these bills always end up being 1,000 to 1,500 pages long, and the devil's always in the details. Well, that's going to do it for part 2, dealing with Joe Biden's tax plan. If you want to hear about part 3, please subscribe to the channel, hit the notification bell. That way, when part 3 is released, you will get notified.